This video gives you a quick experiment in both the real and the nominal money market. Again, it's the same market. I'll go through quickly this time and just walk through the analysis in both cases. So let's do the real money market first. When the money supply decreases in the short run, what happens over here? The decrease in the nominal stock of money decreases real money balances, and this pushes up the interest rate. The same thing actually happens over here in the short run. The decrease in the nominal money supply directly decreases the money supply, pushing up interest rates. So it's exactly the same effect initially. We went from little m 0 to m1. This is a jump, this is a jump, this is a jump, and that is a jump. Now, in the long run, we know that prices will eventually adjust to offset this. In this case, the real money supply will shift back to the right as prices decrease. And in this case, this curve will shift down to the left as prices decrease. So, in the long run, we will get a decrease in the price level, which is going to raise this and lower the interest rates. So that will slowly happen as this slowly comes back, this crawls back, and this crawls down. In this graph, this feeds into prices which show up here. So in the long run, the price level declines, which leads to a decline in the nominal money demand as this falls. That's going to move it down to here. This is a crawl. This is a crawl back down, and we arrive back over to here, which slowly decreases the interest rates. So, let's look at the time paths. We have the log of money, not capital M, that's a nominal money stock, log of price levels, and the log of little m, real money. We start here, right, dotted line, and the money supply declines. That's this initial drop, that's the minus 10% drop. This is eventually going to decline to there, but it comes down this way. This is M over P, so M dropped, so this initially drops. But as prices fall, little m rises back up, so we eventually rise back up to here. Interest rates do the opposite of this, so I'm going to draw it over here. These don't have to be set up next to each other. They're not, there's no equal sign here. Interest rates go up and then return to their old level. Same thing over here. Again, these are natural logs. I'm going to leave the log sign off. I put it over here. And this is interest rates. We know this declines like that. This slowly goes down. Because I know what happens here and I know what happens here, I can figure out what happens here. We get a drop and as the denominator declines, this rises back up to here. Note these dashed lines are just so I know where to go. Interest rates increase. And then decline back to there. So we've done it both cases. It's the same. The only difference is which curve moves in the graph is a little different.